Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings, which, let's be honest, are usually about as exciting as watching paint dry. But hey, someone's got to do it, right? Today we're diving into Southport Acquisition Corporation's annual report. Spoiler alert, it's a special purpose acquisition company, or SPAC, that's been struggling to find a deal, so buckle up, it's going to be a ride. This report paints a picture of a company racing against the clock, with a ticking deadline that could leave investors empty-handed. We'll break down their financials, explore the risks they face, and see if there's any hope for a happy ending. Is there a strategy? Are there red flags? Keep watching. So this is an annual report, like a yearly checkup for the company, and it's required by the Securities and Exchange Commission, SEC, to keep everyone in the loop. Southport Acquisition Corporation, the name itself tells us little. It's a blank check company, meaning it was formed to find and merge with a real operating business. They've been given until September 30th, 2025 to complete a deal or the ship goes down unless they get another extension. The aggregate market value of common stock held by non-affiliates was roughly 58 2024. This gives you an idea about the scale of the company. The aggregate float is very small and can affect liquidity. The big news here is their proposed business combination with Angel Studios, a media company. This is what they've been working towards, but there's no guarantee it will actually happen. Now we get into the cautionary language, the stuff lawyers make them say. Basically, lots of things could go wrong, so don't take anything for granted. The report lays out the risks, and there are plenty. The deal with Angel Studios could fall apart. They might not get the necessary approvals, or the market could sour on them. That's business, folks. Here we have a summary of the company business, and it is a shell company. In other words, a blank slate. All their activity has been about finding a company to merge with. The company states that if the Angel Studios deal falls through, they will be looking for companies with competitive advantage in an attractive growing market and with favorable terms and promising financial model, which, while good traits to look for, doesn't really set them apart from any other investor looking to buy a company, other investor looking to buy a company, other investor looking to buy a company. It is indicated here clearly that the registrant is a shell company, making it subject to shell company risks, which are substantial. Here is again more data of the public float of a company. This is good to know as a trader to understand liquidity. Risk factors, the scary part. Every company has them, but for a SPAC, they're extra important. This is where they lay out all the things that could sink the ship. First, they have no operating history or revenue. That's because it is a shell company. No operations, no sales equals no clue how they'll perform. Then they are also worried about their ability to continue as a going concern. In plain English, the accountants are worried they might run out of money. Not a good sign. Then the clock is ticking. They have to complete the combination deal before September 30, 2025, or they dissolve. This creates pressure. There are conflicts of interest. The management team might have incentives that don't align with regular shareholders. That's why oversight is extremely important. Also, the money in the trust account, the fund meant to back the deal, isn't fully protected. Third parties could make claims that reduce the amount everyone gets back. This is also not a good sign. Also, their ability to redeem is unattractive to business combinations. This is self-explanatory. Now we get to management's perspective and of their operations. Time to see some numbers. For the year, the net loss was $5.1 million. This is due to the fact that they are racing to close a deal and had to pay fees to make it happen. They only had about $495,000 in cash held outside of the trust account. That's not a lot to work with. Again, we have here management confirming that they may not have enough cash to continue operating in the future, which is one of the main reasons that they need to do a business combination. Let's look at the leadership. Are they experienced? What's their background? Jeb Spencer is the CEO with a long history in software and is an executive at TVC Capital, a software growth fund. Jared Stone is the chairman. He has 27 years of investment experience and formerly at Northgate Capital, a $4.5 billion global private equity investment firm. Sigmund Anderman has a long history as well. Founder of Ellie Mae. He was also named one of the 10 most influential people in the mortgage industry in 2005. Jennifer Knuckles also has an impressive background as the current CEO of a biosafety technology company and former executive at SoFi. Kathleen Schreiner Gates is the former CEO of Simple Nexus. David Winfield, other than being a former professional MLB player with many accolades, also has vast leadership experience. Okay, potential conflicts of interest. This is a big one, as they are a SPAC, and this is basically par for the course. Their officers and directors might have other obligations that pull them in different directions. The audit fees from BDO, their accounting firm, jumped from $125,000 in 2023 to $21,830 TD in 2024. That's not a huge red flag, but something to keep in mind. And finally, we get to the exhibit index, which is a listing of all the legal agreements and documents that are referenced in the report. So what's the overall picture here? Southport Acquisition Corporation is in a tough spot. They have a limited time to find a deal, and their financials aren't exactly stellar. The merger with Angel Studios seems like their best bet, but it's not a sure thing. Their strength lies in their experienced leadership, who have vast leadership experience in the world of finance and real estate, including successful technology companies and the capital, to make things actually happen. But the limited time and the high possibility that they will return cash is worrying and dilutes any bargaining power that they might have. They do have major risks, as their financials are weak and there is uncertainty around the business combination closing. In conclusion, this is a high-risk, high-reward situation. If the Angel Studios deal goes through, there could be upside for investors, but if it falls apart, there's a real chance of losing your investment. Remember, this is just one person's opinion. Do your own research and never invest more than you can afford to lose. Thanks for watching Corporate Decoder. If you found this video helpful, please like, comment, and subscribe for more deep dives into the world of corporate filings.